Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, March 8th, 2021, and I'm pre-recording this Trading Places Live for Tuesday, March 9th. Currently, futures are looking pretty strong for Tuesday. We had a reversal on the Dow on Monday after moving to an all-time high above 32,000. We were unable to close above 32,000. We saw a lot of relative weakness again on the NASDAQ and in growth stocks. We'll talk about that in a bit. Yeah, at least for now, futures looking pretty good. Of course, things can change overnight. We'll see what happens in the morning on Tuesday, but at least for now, futures are looking pretty strong for the Tuesday open. Before we get into the actual recap of the action on Monday, I do want to just walk you through the agenda. So we'll go through that daily market recap. Then we'll get into talking technically. I want to talk a little bit about the rising dollar. I've been calling for the dollar to rise. We're starting to see that. We've had a pretty steep increase here of late. So we'll go through that. Then I want to walk you through ChartLists and how I scan against, one particular scan anyway. I'll show you how we can use some of the research materials that we have at Earnings Beats to come up with some pretty good information for you. And then we'll wrap up with the earnings spotlight and the 3 you must see. All right. Well, before we get into the daily market recap, let me just remind you, if you are new to Earnings Beats, you can sign up for our free Earnings Beats Digest newsletter, which is published Mondays, Wednesdays, and Fridays. Simply type in your name, email address here, hit the subscribe button, and we'll make sure you get added to the list. We'd love to have you. Normally, it's a quick couple paragraphs and a chart dealing with earnings, sometimes relative strength, but we do try to make it very educational in nature. I think you'll enjoy it. There's no credit card required. You can unsubscribe at any time. Again, just type in your name, email address, hit that subscribe button. We'll get you set up. Or if you'd like to try our service for 30 days at no cost, you can click on this Join Today button. Our portfolio performance, just one piece of what we do at Earnings Beats. We have a pretty extensive research platform and educational platform that I think is really good for our members. But here are our portfolios. Great long-term track record. This quarter off to a rough start. 3 of our portfolios are heavily into growth stocks. We'll see how growth stocks perform throughout the balance of the quarter, but at least since we identified these stocks, announced our stocks back on February 19th, we have seen a lot of weakness in growth, a lot of rotation into value. So the current quarter certainly been a very challenging environment for growth stocks. We'll see what happens over the course of the balance of the quarter. Our income portfolio this quarter has actually done extremely well. There are some energy, well, not energy, there are material stocks in there. There are also financials, but these are all dividend payers. And generally speaking, they're going to be a little bit more conservative, not as volatile. And because of what's happened in the market with so much shift towards value, you can see this quarter income has done very well, but the other areas and the other portfolios have not. We still have quite a lead over the S&P 500 on a since inception basis, but this quarter certainly has been rough. Let's go ahead and jump into the action on Monday. As I mentioned, the Dow Jones Industrial Average did break above 32,000. You can see that set an all-time high intraday, but we came back down and closed at least 300 points off of that earlier high. The Dow still finished with a 300-point gain, but we did have a false breakout. So we'll have to see whether or not on Tuesday we can make another run at that 32,000 level. S&P 500 was down 20. We did have bifurcated market action. The S&P 500 down mostly because of weakness in technology. It's been a very, very difficult couple of weeks, maybe few weeks for technology shares. I think things will change there, but at least for now, that is not the case. A lot of selling going on in the technology area. NASDAQ, of course, technology laden. So you can see the effects of technology not doing well in how we've been trading on the NASDAQ. One of the things that I did talk about recently with members when we lost our this 13,000 support level, if you actually connect the highs and develop the top of a channel and then take that same slope and come down and connect this low at the beginning of November, it actually comes across here probably somewhere between the 12,000, 12,500 area. So I was looking for, once we lost 13,000, I'm not at all surprised to see us down in the 12,000s. I think we could still have a little bit more downside. Although, as I mentioned at the top of the show, we do have futures up, at least for now. And again, this is being pre-recorded, so this is Monday evening. But we'll see what happens on Tuesday and whether or not we can hold the lows that we printed on Friday. Had a huge reversal on Friday, if you recall. We didn't violate that on Monday, but it could still come into play. So that'll be something to watch. Mid caps actually up 18 points. So I mentioned the bifurcated action. The Dow up 1%, S&P down 0.5%. The NASDAQ down almost 2.5%. Mid caps, though, were up 0.75%. Small caps were up 2%. So literally, it was all over the place on Monday. But mid caps tried to get back up close to that 2,600 level, didn't quite make it. And small caps broke out. We closed at an all-time high on Monday. So literally, we're all over the map. The good news, and this is something I've talked about for the last few months, once we've started to see, the money rotating into the value area, yes, no doubt about it, it's hurting us from a growth perspective in the short term. But big picture, I'm really excited by the fact that these value stocks are breaking out and they're starting to perform well, because in a secular bull market, you do want wide participation. You want everything moving to the upside. You want basically nowhere for the bears to turn. And so I think eventually what we're going to see is that interest rates are going to stabilize. 10-year Treasury yield, I think, is spooking a lot of folks right now. I think yield stabilized on the 10-year Treasury. I think even come back down some. And I think we're going to see some more rotation back out of value toward growth. But also, I still believe we're going to see continuing rotation throughout the year and more new money coming into the stock market. So I see really a lot of different areas benefiting. And when I look back over the past, 2 or 3 months, when we've gone through our portfolio process, and this was back in November when we announced our portfolios, the big question mark for me was not whether the stock market goes higher. The big question mark for me is what leads. Is it going to be the value stocks? Is it going to be the growth stocks? And, it was inevitable that we were going to see a period of at least, couple weeks to a couple months where value stocks outperform. We actually saw it back in June, May of 2020 to about June 8th, middle of May to about June 8th, where value went up. Many of the growth stocks got hit, and then the growth stocks came roaring back. I believe the growth stocks are going to come roaring back. Now, do they go down on a relative basis for another couple of days, another couple of weeks? Is it a couple more months? That's the part that's hard to say, but I would tend to lean on it reversing sooner rather than later. We'll see what happens. As far as the sectors go, energy, another great day, only up 0.2% here. Actually, we got a few different sectors. Actually, didn't mean to include energy on here, but that's all right. I mean, energy's been on fire. We might as well take a look at it as well. But energy up at 53, so we did continue to see movement to the upside. Crude oil reversed on the day, though. So I'm not so sure. It seems to me like energy might be getting a little toppy here in the near term. And especially when I start talking about the dollar, I think you'll find that somewhat interesting in just a bit. Utilities, best performing sector, though, on Monday, up 1.4%. Materials, just slightly less performance, up 1.34%. Materials challenging that January high. I think materials could be in a little bit of short-term trouble, though, and I'll talk about that with the dollar as well. Financials, I'm not seeing a whole lot of trouble here. I do think we'll pull back if yields pull back a bit, but I think the overall trend here remains very strong. And then there's technology and communication services. So technology down 2.4%. You can see the break below the 50-day moving average. Short term, obviously this is problematic. We're going to have some damage to try to repair here. But this right here, this chart and this breakdown and the PPO turning negative, all of this is why you're seeing the NASDAQ underperform. Communication services also had a rough day, but it was up near all-time high territory before it reversed. So a little bit of congestion up here in the 73, 73 and a half area. We'll see whether or not we can get through that. If not, I wouldn't be too overly concerned as long as it remains above about 70, can stay above that 50-day moving average. So that's what I'd be looking for there. All right, let's keep moving on. 10-year Treasury yield. We're not expecting any significant economic news out on Tuesday. Don't know if that's good or bad for the market, but we did get that initial pop here on the 10-year Treasury yield up above 1.60% at the end of February, pulled back to about 1.4, and now we're back up challenging again. This could turn out to be a double top and a pullback. That's a little too early to call at this point. We want to see a reversal back to the downside. But I think this holds the key short term to what happens with the growth versus value. Because growth stocks obviously are going to do better in a lower interest rate environment. I mean, look at the numbers, 1.6%. We're still in a low interest rate environment. However, a downtrending low interest rate environment would be better than an uptrending low interest rate environment. And so I think that's what maybe the market's going to need and what some of the technology stocks and growth stocks are going to need maybe to settle down here in the near term. So watch the 10-year Treasury yield pretty closely. Let's move on. I want to talk a little bit about long-term, market action. So this is part of our talking technically today. This is a chart that I show quite often. And I think it's really important, number one, more important than stock selection, more important than growth versus value, more important than small caps versus large caps. The biggest thing to be able to recognize is whether or not you're in a secular bull market or a secular bear market. And I don't think there's any doubt at this point with the Dow Jones hitting an all-time high again today, small caps closing at an all-time high. Yes, NASDAQ's been weak, growth stocks have been weak, but we're seeing rotation. Those were areas that have carried us for quite some time. It's okay to allow them to pause while we get other areas up to speed. So the big picture is what I'm trying to stay focused on. And the S&P 500, the NASDAQ, the Dow, the Russell, the mid caps, everything looks really good to me as we go forward. I believe the market continues to do very well in 2021. And as we go forward, I think growth in our GDP is going to be much stronger. I think all of that's going to add up to a very strong bull market run. And if you look back at history, when you get these secular bull markets right, over time, it's not going to matter really what you're in, although in a secular bull market, the aggressive groups do lead for the most part. And when I say aggressive groups, I'm talking about technology, talking about consumer discretionary, communication services, financials, and industrials. Those are the areas that you generally are going to want to concentrate on. Energy and materials are a little bit more dependent on other factors, geopolitical concerns, the dollar, and I'll show you that in just a couple of minutes. But I consider energy and materials to be more neutral. We've got our aggressive groups, which I named. Then we've got our defensive groups like utilities, consumer staples, healthcare, and real estate. Those tend to underperform in secular bull markets. Everything tends to go higher, but we're looking for leadership. And over the big picture and over the long term, secular bull markets, you really want to, for the most part, stick with those aggressive areas. All right, I'm going to take a look now at technology relative to the S&P 500. Folks, we got to, keep things in perspective. It's really hard sometimes because you see certain areas of the market just leading and you just assume that it's going to happen all the time, every day, every week, every month. You go through periods where you lose relative strength, even in the best areas. Technology We broke out into the secular bull market back in April of 2013, right here. When you break out above these prior tops, all of this sideways consolidation, that to me is what starts the secular bull market. Not down here in 2009, because you don't know you're starting it in 2009. You don't know that this started the uptrend until you break out. That's not just true with the S&P 500 on a long-term monthly chart. That's true of any chart. You don't know that the trend has started until you begin to do what uptrends do, which is break out, hold moving averages, break out again. And that you don't know in this long-term chart until we break out in April of 2013. So looking at technology and looking at it relative to the S&P 500, here were some key breakouts. 2009, double top. Now, this is a relative chart. So this is how technology is doing relative to the S&P 500. 2009, we make a breakout. 2015, we moved up for a few years, 3 or 4 years, pulled back for, in this case, about 9 months relative to the S&P, and then we took off again to the upside. Now, the last 2 years, we've seen tremendous relative strength in technology. It's because, quite honestly, their earnings have exploded and in a fairly low interest rate environment. I believe rates are going to stay relatively low, and I believe earnings are going to continue to go higher. So I think technology is going to remain a leader. Now, is it going to continue straight up? Are we going to consolidate a little bit for a period of time and then turn back up later? That's really hard to say. But I do believe technology is an area that you want to continue to have a very significant representation in. The consumer discretionary area. I mean, again, you look, breakout, move up into 2013, we pull back 2014, and then we break out again. 2015 to 2018, over 2 years here, we didn't break out on a relative basis. Once we did, next 21 months or so, 7 quarters, we went up relative to the S&P. Then we had a pullback, held the prior low, and then we made another breakout. This came in May of 2020 during the pandemic. After making that breakout, we've pulled back, and it looks like we're just trying to start to turn back up again. We'll see how this goes. But I expect consumer discretionary in a secular bull market to continue to outperform. So this is something we need to watch. Communication services just broke out relative to the S&P 500. So you got, technology pulling back, consumer discretionary pulling back, communication services breaking out. Industrials, the strength here is pretty apparent. We do have a key area now we're going to have to try to negotiate. Got this relative downtrend line that's probably about to be tested. So we've got hurdles, but overall, I think industrials look pretty good. And then you got the financials. And financials right now look best of all. Now, a lot of that has to do with 10-year Treasury yield, which has been on the move to the upside. If we do consolidate that 10-year Treasury yield, move a little bit sideways, maybe pull back a little, we might see a little bit of relative weakness in the short term. But there's no doubt since that vaccine news came out in November, financials have been one of the leaders. And so this is an area definitely that we should continue to keep on our radar. But my point here is that all 5 groups either are showing short-term strength, relative strength, or they've been showing long-term relative strength throughout the secular bull market. There really isn't, if there's one group that might be a little weaker than the rest, I would say is industrials. Not because of, the last month or the last 10 months, but because of the last few years and where we stand right now on this relative chart. So I'd be a little bit more concerned there. Anyway, I continue to like what's going on here. Now let's talk a little bit about the rising dollar. This is a chart that I follow. I've talked about it many times, so I don't want to bore those of you who have listened over and over again. But at the same time, I know we have some new folks listening in. So I'll try to be kind of quick here. 10-year Treasury yield in the U.S. minus the German 10-year Treasury yield. That's what is plotted here, just the difference between the two yields. If you look at the direction of the difference between the yields and between these two countries and look at the direction of the dollar, I think you'll see hey, they seem to be going pretty much the same. Well, they do, except the shaded areas are highlighting where they diverge. So the green shaded areas are showing US Treasury yields moving up faster than Germany. I would expect the dollar to go up because we're rising through these green shaded areas, but the dollar was falling. And so it resulted in inverse correlation, which we don't see very often. This is a 15-year chart, by the way. So just recently, we saw the 10-year Treasury yield. We've seen the yield moving up here in the US. It's been crushing the yield in Germany. So as our yield moves up faster, it generally is going to result in a stronger currency. Well, the dollar was actually going down for a while. Now, look at the dollar starting to turn back up. This is what we've been anticipating. So we're starting to see that dollar index move back up. And now all of a sudden that inverse relationship is starting to turn back and become positive. And if you look at these previous inverse correlations, look at the move back into positive territory. Every one of them right back up near +1. And each of these three prior, look at the dollar rebound, dollar rebound, dollar rebound. I think the dollar is just starting to make another big move. Now, why is that important? Well, let's get back to materials and energy. Because when materials and energy led from 2002 to 2008, you can see energy relative to the S&P going up, materials relative to the S&P going up. This bull market was led by materials and energy. The dollar was falling the entire time. A falling dollar is generally good for materials and commodity prices and so forth, and energy, which is obviously a commodity. So this relationship, I think, is really important. When we went through a period where the dollar couldn't quite make up its mind, neither could the relative strength of energy and materials. And then once we bottomed, and I was showing you the chart on the 10-year Treasury yield and how that, versus Germany has been going up, and it's signaling to us that the dollar is going to go up. Well, just keep in mind that throughout the last 10 years, 9-10 years, while the dollar's been mostly going up, look at the relative strength in energy and materials. Now, I know everyone's excited about energy and materials right now, and we've got a nice little short-term uptrend going, but we also have a long-term downtrend going as a result of this dollar strength over the last decade. Now, the dollar had a rough year coming down, and I think that has helped energy and materials. Materials turned up on a relative basis almost exactly at the time the dollar went down. Energy took a little bit longer, but both are going up right now, and the dollar's just starting to go up. I think if the dollar keeps going up, I think that's going to make it very difficult on energy and materials. We'll find out. Next up, ChartLists. I want to just show you a scan that I run, or I can run. And the way you do this, first of all, we have a number of chart lists that we keep at Earnings Beats. And if you're a StockCharts member and an Earnings Beats member, as long as you're at least an extra member at StockCharts, you can download our chart list right into your StockCharts account, which is pretty cool. But we keep a number of different chart lists. So the first thing I want to do is just show you a new scan, how you can do a new scan. Now, we have filters already in our chart list, so I don't need to average volume be over a certain level because stocks are not going to be in our chart list if they're not liquid, if they're not already, trading a certain number of shares, usually a couple 100,000. So what I want to do is I just want to very quickly show you a quick chart list that you can run here. So strong earnings, add, and we actually have a second strong earnings, add that, and then raised guidance. So these are companies that have raised their guidance, and we keep track of that on a separate chart list. And then I'm going to pull up scooters and add that, and I want this to be greater than 95. So I really want strong stocks. Now, here, if I run a scan like this, I'm going to come back with 0 results because strong earnings 1 and strong earnings number 2 do not have any of the same stocks. They're all different stocks. So if I'm asking the scan engine to show me all the stocks that are on this chart list and each of these other 2 chart lists, it's not going to work. So what I have to do is I have to put in my little brackets here. Change this and to or. So now I'm saying, give me all the stocks that are in either one of these earnings strong earnings chart lists, and raised guidance, and have a scooter greater than 95. Check syntax, we're good, and then I run the scan. Right now, we have 8 stocks on here. So this is a good place to maybe take a look. These are companies that have beaten earnings in their last quarter, beaten revenue and earnings per share in their last quarter. They're liquid. They look decent technically, and their scooter scores are above 95. This is a good, solid list of fundamental companies and good technical charts. So this would be a great way to take a look at some. And I know one of our portfolio stocks that's done extremely well has been Sleep Number. So Sleep Number, which we put out on February 19th, I don't know, it was around 120, went up over 150, came all the way back to 120, starting to make its move back up. But this one has been volatile, but still very strong. But you can go through and take a look at some of those. All right, earnings spotlight. Going to go through these kind of quick. Not a whole lot to go over here. This is a stock, Context Logic, ticker symbol WISH. Been in just a horrible downtrend for the last 5 weeks. Looks a lot like many of the growth stocks. Stock's lost 50% of its value in the last 5 weeks. They did come out with earnings after the bell. Loss was bigger than expected. However, stock is actually up 5% in after hours. That's not a lot, though. Probably back towards 17. Still in this downtrend. Needs to reverse that. Stitch Fix came out after the bell. They did beat 20 cents or 20-cent loss versus 22-cent loss expected, but they lowered their revenue guidance. I think they came up short on their revenues. Stock's down 22% after hours. Holding into earnings, you're always taking a big risk. Tomorrow morning, got a couple stocks reporting. Dix will be reporting DKS. Stock looks pretty good technically. AD line looks strong. Relative strength breaking out versus specialty retailers. I would look for a pretty good report here out of Dix. Navistar also reporting. AD line strong. You can see not really much action here, though, on Navistar for quite some time. And the last one I'll show you is THO reporting in the morning. This is Thor Industries. Expected to earn $1.60. Actually did make a breakout on the close today. So heading into earnings, breaking out. Relative strength been picking up. It'll be interesting to see. I mean, I would think the numbers will be good here. For any reason we pull back, I'd watch that rising 20-day moving average. All right, let's wrap up with the 3 you must see. I'm going to show you 3 different stocks that are showing shooting stars or potentially, bearish candles. At least these first 2. I'm not sure if the third one, what that one looks like. Well, let's go through these. PVH Corp. First of all, it's in clothing and accessories. It's been very strong relative to its peers, but it did have a false breakout over that January high. Needs a close over 110. Without that, maybe short term, we might get a 20-day test here. But learn to recognize these tests of resistance and failures. From a trading perspective, that could be quite profitable. Next up, Lincoln National LNC. Tried to make the breakout, could not. Pulled back. This is another one. Needs to close over about 16.25. Without that, look for that rising 20-day test. And the last one I'm going to show you, AXNX. This is another one. Tried to get through. We've had multiple attempts at 57.5. Haven't been able to do it. We got up to 59.18. Could not hold. Reversed back down. Not looking good in the short term. Longer term, not so bad. One of a pretty good stock in the medical supply area. But I don't like to see those false breakouts like that. All right, going to wrap up. Everybody have a great Tuesday. Be back on Wednesday for your next Trading Places live show over at earningsbeats.com. Again, have a great Tuesday, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.